Summary of the Little Book of Common Sense Investing by Jack Bogle. Introduction: The Wisdom of Simplicity. Jack Bogle, the founder of Vanguard Group and the creator of the first index fund, wrote the Little Book of Common Sense Investing as a guide to help individual investors make sound, practical decisions about their investments. The central premise of the book is rooted in simplicity. Investing should be straightforward, low cost, and focused on the long term. Bogle's message is clear. Successful investing doesn't require complex strategies or insider knowledge. Instead, it requires discipline, patience, and a commitment to a simple, proven approach. The case for index funds. At the heart of Bogle's investment philosophy is the index fund, which he argues is the best vehicle for most investors. An index fund is designed to mirror the performance of a specific market index, such as the S&P 500. This approach contrasts with actively managed funds, where fund managers attempt to outperform the market through selective investments. Bogle's advocacy for index funds is grounded in their lower costs, greater tax efficiency, and the fact that they consistently outperform most actively managed funds over the long term. He emphasizes that the costs associated with active management, such as management fees, trading costs, and taxes, erode the returns that investors can achieve. By investing in a broad-based index fund, investors can capture the full return of the market, minus minimal expenses, thereby increasing their odds of long-term success. The fallacy of stock picking and market timing. Bogle warns against the allure of stock picking and market timing, two strategies that many investors believe can lead to superior returns. He presents data showing that even professional fund managers, with all their resources and expertise, struggle to outperform the market consistently. Bogle argues that trying to pick winning stocks or time the market is not only difficult, but also unnecessary for achieving good returns. He explains that the market is highly efficient, meaning that stock prices generally reflect all available information. As a result, it is nearly impossible to consistently identify undervalued stocks or predict market movements. Bogle's advice is to avoid these speculative strategies and instead invest in the entire market through index funds, allowing the power of compounding to work in your favor over time. The impact of costs on investment returns. One of the most critical themes in Bogle's book is the impact of costs on investment returns. He argues that the true enemy of the investor is not market volatility or even poor stock selection, but the excessive costs associated with investing. These costs include expense ratios, transaction fees, and taxes, all of which can significantly reduce an investor's returns. Bogle uses the concept of the arithmetic of investment returns to illustrate this point. He explains that the gross return of the stock market, minus the costs of investing, equals the net return that investors receive. Since costs are certain and returns are uncertain, minimizing costs is the most reliable way to improve investment outcomes. Bogle advocates for low-cost index funds as the most effective way to reduce these costs and maximize returns. The power of compounding and long-term investing. Bogle is a staunch advocate of long-term investing, and he dedicates a significant portion of the book to explaining the power of compounding. Compounding is the process by which investment returns generate earnings on themselves over time, leading to exponential growth. Bogle argues that the key to harnessing the power of compounding is to start investing early, remain disciplined, and allow time to work in your favor. He stresses the importance of staying the course, even during periods of market turbulence. Bogle acknowledges that the stock market can be volatile in the short term, but he argues that over the long term, the market has consistently delivered positive returns. By maintaining a long-term perspective and avoiding the temptation to react to short-term market fluctuations, investors can reap the full benefits of compounding. The virtue of diversification. Diversification is another fundamental principle in Bogle's investment philosophy. By spreading investments across a wide range of assets, investors can reduce the impact of any single investment's poor performance on their overall portfolio. Bogle explains that index funds inherently provide diversification because they include a broad range of securities within the market they track. Bogle argues that diversification not only reduces risk, but also increases the likelihood of capturing the market's overall return. He advises against concentrated investments in individual stocks or sectors, which can lead to significant losses if those investments perform poorly. Instead, he recommends a diversified portfolio of index funds that covers different asset classes, such as stocks and bonds, to achieve a balance between risk and return. The importance of asset allocation. Asset allocation, the process of determining the right mix of stocks, bonds, and other assets in a portfolio, is a critical decision for investors. Bogle emphasizes that asset allocation should be based on an individual's risk tolerance, time horizon, and financial goals. He suggests that younger investors with a longer time horizon should have a higher allocation to stocks, while older investors closer to retirement should have a higher allocation to bonds to reduce risk. Bogle also discusses the role of rebalancing, which involves periodically adjusting the portfolio's asset allocation to maintain the desired level of risk. Rebalancing ensures that the portfolio remains aligned with the investor's goals and risk tolerance, even as market conditions change. Bogle advises investors to rebalance their portfolios regularly, but not too frequently, to avoid unnecessary costs and taxes. The impact of emotions on investing. Bogle recognizes that emotions can be a significant obstacle to successful investing. Fear and greed, in particular, can lead investors to make irrational decisions, such as selling during market downturns or chasing after the latest investment fad. Bogle advises investors to remain disciplined and stick to their investment plan, regardless of market conditions. He emphasizes the importance of having a clear investment strategy and maintaining a long-term perspective. By focusing on their long-term goals and avoiding the distractions of short-term market movements, investors can reduce the impact of emotions on their decision-making. Bogle also suggests that investors regularly review their investment plan to ensure it remains aligned with their goals and risk tolerance, making adjustments as needed. Conclusion: the gift of common sense. In the final chapters of the book, Bogle reiterates his core message. Successful investing is not about beating the market, but about capturing the market's returns in a low-cost, diversified, and disciplined manner. He urges investors to embrace the common-sense principles he has outlined, investing in low-cost index funds, maintaining a long-term perspective, minimizing costs, and staying the course. Bogle's advice is both timeless and practical, offering a roadmap for investors to build wealth steadily and securely over time. He acknowledges that the simplicity of his approach may seem counterintuitive in a world that often celebrates complexity and sophistication, but he argues that the simplest solutions are often the best. By following these principles, investors can avoid the pitfalls of active management, reduce the impact of costs on their returns, and achieve financial success through the power of common sense investing.